Mo money, mo problems. Our session is on capital structure. We cover 8 topics: capital structure criteria, financial leverage, the magic of financial leverage, the Miller and Modigliani propositions, selecting a capital structure, the benefits of debt and the costs of debt in terms of financial distress, and finally, optimal capital structure. The criteria for determining capital structure are to select the structure that minimizes the overall cost of financing, where the overall cost of financing is measured by the weighted average cost of capital. So we want to select the structure that maximizes the value of the firm, which is the same thing as selecting the structure that minimizes the overall weighted average cost of capital. And we want to answer the question, what is the effect of a change in the financing mix on firm value? Or is there an optimal capital structure? Can we identify an optimal capital structure? Capital structure is typically defined by the use of financial leverage, which is itself defined by the use of relatively cheap debt to increase expected return on equity. Financial leverage is measured using a couple of financing ratios or financial ratios. One is the debt financing ratio, which we've encountered before, and that is the ratio of debt over debt plus equity, or the ratio of debt over assets. A second financial ratio is the ratio of long-term debt to capitalization, which is measured as long-term debt divided by long-term debt plus equity, where long-term debt plus equity is called capitalization and defines the permanent capital structure or financial structure of the firm. Note that in calculating these ratios, we want to use market and not book value of debt and equity. Financial leverage can produce seemingly magical results for shareholders. To demonstrate this possibility and to mix literary references, let's consider the firm Macbeth Spot Removers and tell a tale of 2 capital structures. Macbeth Spot Removers is in the business of removing spots. We want to look at the firm's performance under 2 capital structures. First, Macbeth Spot Removers is all equity financed. It has $10,000 worth of assets that it employs in the removal of spots. It finances these assets with $10,000 in equity, composed of 1,000 shares of stock at a market value of $10 per share. Now, let's run Macbeth Spot Removers for a year and remove some spots. What happens in a particular year depends on the markets within which Macbeth Spot Removers operates. It operates in a product market where it sells its service, and it operates in a set of factor markets where it hires people and other production inputs to remove spots. There's business risk in all of these markets, and hence there's business risk in Macbeth Spot Removers' operating results. Its operating results are represented on this line, net income before interest. And you can see we have a range of results running from $500 up to $2,000. This operating result is before any payments made to the suppliers of debt and equity financing. The most likely operating result, as evaluated by the financial markets, is given here in bold. So the markets expect Macbeth spot removers to earn $1,500 in net income before interest. Now, because the firm has no debt, it pays no interest expense, and therefore net income is also $1,500. Earnings per share are $1.50, calculated as net income here divided by the number of shares outstanding. And return on equity is 15%, calculated as net income divided by the market value of equity. Now let's see what happens when Macbeth spot removers changes only its capital structure. The firm borrows $5,000 on which it pays 10% interest, uses the proceeds of the loan it takes out to buy back half of the shares, that is 500 shares, at $10 per share. It puts those shares into the treasury. So now it has $5,000 worth of equity value still owned by its owners, $5,000 in debt value, and it still has the same asset structure as it had in the all equity finance case. It still has $10,000 worth of equipment that it uses to remove spots. It has the same, essentially the same operating processes as well. Now let's run the firm for a year, removing some spots, and see what happens. Again, let's look at the likely result, which again is going to be $1,500 because there's been no change in the operating processes of the firm. But now, because the firm has $5,000 in debt on which it pays 10% interest, it has to pay $500 in interest expense, leaving $1,000 in net income. Now, earnings per share have risen from $1.50 to $2, once again calculated as net income divided by the number of shares outstanding. And the return on equity has gone up from 15% to 20%, calculated as net income divided by the value, the market value of equity. So here, in this comparison between what happens in the all equity financed most likely column here and the half levered most likely column here, we see the seemingly magical results of financial leverage from the perspective of the owners of the firm. They see their return on equity rising to 20% because of the use of debt, which is relatively cheap compared to the cost of equity. Now let's consider what can happen to shareholders if Macbeth spot removers experiences some other business result. Let's look at essentially the worst case business result here, where the net income before interest is $500. Again, no interest expense, net income of $500, earnings per share now have fallen to 50 cents, and the return on equity is 5%. And you can see now, just looking across this row, that we get a range of outcomes in terms of return on equity to the shareholders of from 5% to 20%, depending on the business result of the firm. Okay, let's compare the range of results that are available to shareholders in the all-equity finance case to what happens in the case of the firm that is financed by half debt and half equity. Again, we're going to look at the worst case result, which is a $500 operating result. But because the firm has $5,000 worth of debt and it pays 10% interest on that debt, all of the net income before interest goes to pay the interest expense, leaving nothing left in terms of net income, and hence the return on equity is 0. And you can see by looking across this row that the range of outcomes available to the shareholders is from 0% to 30%. So what we see is that the range of results in the unlevered case is much narrower than is the range of results in the half-levered case. The effects of financial leverage then can be summarized as financial leverage increases the return on equity for the likely business result. In addition, financial leverage increases the variability in return on equity. That is, it adds financial risk, and the effect on the value of the firm associated with using financial leverage is going to depend on whether the cost of debt and the cost of equity rise when the firm decides to use financial leverage. So what happens to the cost of debt and the cost of equity as a firm adds debt? Two financial economists, Miller and Modigliani, won the Nobel Prize for Economics for answering this question. They answered it by developing two propositions. Proposition 1 is that in perfect capital markets, defined as markets with no taxes, no transactions costs, free flow of information, and no other imperfections, in those types of markets, the value of the firm is determined by the left side of the balance sheet, that is the asset structure, and not by the right side of the balance sheet, which is debt and equity. M&M Proposition 2 is that the required return on equity increases as the firm adds financial leverage. Specifically, it increases in proportion to the ratio of debt over debt plus equity, or debt over assets. The implications of these propositions are, first, that in perfect capital markets, there is no optimal capital structure for the firm. The firm can use whatever mix of debt and equity it chooses. Hence, to find an optimal capital structure for a firm, we have to find the market imperfections and evaluate them. Here's a brief math proof of the M&M propositions that uses some of the relationships we've developed earlier in the course. First, return on assets is defined, as we've noted, as expected operating income divided by the market value of all securities. Now, all securities means financial securities, so the market value of all securities is the market value of debt and equity, or the market value of the assets of the firm. We also know that the overall discount rate, which we've previously labeled R sub A, and we've also sometimes called the weighted average cost of capital, is equal to the weighted average of the cost of debt and the cost of equity, where the weights are the debt financing ratio and the equity financing ratio. Now if we solve the weighted average cost of capital formula for the required return on equity, something we've done in the past, we get that the required return on equity is equal to the return on assets plus the return on assets minus the return on debt times the ratio of debt to assets. So what this expression indicates is that as the debt financing ratio rises, the required return on equity goes up proportionally. And that's exactly Miller and Modigliani's proposition 2, that the required return on equity is proportional to the amount of leverage that the firm employs. Let's see how this math applies to Macbeth spot removers. In the top part of this slide, I have the information we've looked at previously. In the bottom portion of the slide, I've indicated the calculations for R sub A, R sub D, R sub E, and the weighted average cost of capital. To see how each of these numbers has been calculated, let's go over to our financing Excel file, and we're on the worksheet entitled Macbeth Spot Removers. And here's where I made the calculations. So first I calculated the return on assets, and you can see it's simply net income before interest divided by asset value. And I did that for both the unlevered and the levered cases. Then I calculated, or indicated, just wrote in, the cost of debt, which is 10%, the interest rate on debt. Then I used the formula on the previous slide to calculate the required return on equity. We just kind of indicate here that the required return on equity is equal to return on assets plus the difference between the return on assets and the cost of debt multiplied by the ratio of the debt value to the equity value. Did that for the unlevered case, which gave us a required return on equity of 15%. And then I did it for the levered case, and we get a required return on equity of 20%. Finally, I calculated the weighted average cost of capital for these two cases using the weighted average cost of capital formula that's very familiar to us. And so what we get is the weighted average cost of capital is 15% in both cases, or independent of the use of financial leverage. And that is because the required return on equity has gone up just in proportion to the debt financing ratio. These next three slides present three different views of the relationship between the use of leverage and the cost of financing for the firm, or the relationship between leverage and firm value, are really three different perspectives on how to select a capital structure. First, we have the naive view, which says that because the cost of debt, down here maybe at 10%, is below the cost of equity, up here it may be 15%, that as we add debt to our capital structure and calculate the weighted average cost of capital, we're going to continually reduce the overall weighted average cost of capital, or the overall cost of financing, because we simply shifted from expensive equity to cheap debt. Our weights have changed, and so our weighted average cost of capital declines. Note that this naive view assumes that the cost of debt and the cost of equity are independent of financial leverage or independent of debt financing, and that the firm can continue to add debt without suffering any increase in the interest rate it pays or suffering any increase in the required return that the shareholders impose. And the implications of this naive view is that financing cost can be minimized, and thereby firm value can be maximized through the full use of debt, or put another way, full leverage is optimal. A second view of leverage and the weighted average cost of capital is the M&M view. According to Miller and Modigliani, as you add debt, moving this way, the required return on equity rises in proportion to the debt financing ratio. So the addition of relatively cheap debt is just, as you go this way on the debt financing axis, is just exactly compensated by the fact that the required return on equity increases, so that the overall weighted average cost of capital, or the overall cost of financing, is constant. The implications of the Miller and Modigliani view is that financing cost, and therefore firm value, are unaffected by the use of debt. The third view of leverage and financing cost has been called the traditional view. This view holds that as the firm adds debt financing, the required return on equity rises, consistent with M&M. The required return on debt rises as well, but that when we take the weighted average of these two lines, we map out a U-shaped weighted average cost of capital curve, and we can find a minimum point or a bottom to this U-shape, which maps out an optimal capital structure. So the implications of this traditional view are that financing costs can be reduced, and therefore the firm value can be increased through the judicious use of debt. Where does the identification of an optimal capital structure come from in the traditional view? Or put another way, under what circumstances do the M&M propositions not hold? We need to turn to market imperfections for some guidance. In general, a firm should use more debt if it benefits from the existence of more debt subsidies. Now, debt subsidies come in the form of income tax deductibility of interest expense for tax-paying companies, perhaps access to tax-exempt debt on the part of not-for-profit firms. And a firm should use less debt if it is in a situation where it's more likely to face financial distress. That is a situation where it faces higher business risk. or where, when it is in financial distress, the financial distress is more severe for the debt and equity suppliers. And that's a case where the firm has few assets that can be monetized or turned into cash to compensate the debt and equity suppliers. Let's consider more fully the benefits and costs of using debt in the case of market imperfections in the financial markets. Let's focus first on the important market imperfection of the income tax deductibility of interest expense. This market imperfection lowers the weighted average cost of capital because of lower net cost of debt to the borrower. That is, the income tax deductibility lowers the net interest rate on debt that's paid by the borrower. Here's the formula for the weighted average cost of capital adjusted for the income tax deductibility of interest expense. The adjustment is in this term here, and it's an adjustment that we've seen earlier in the course. Here we are back at our financing Excel file, and I've copied the worksheet that we labeled Crow in our investing Excel file into this file so we can kind of review what we did for Crow Hardwoods when we're considering the company cost of capital. Recall that our calculation for the weighted average cost of capital for Crow used these numbers down here and arrived at a weighted average cost of capital of 7.5% in the absence of income tax deductibility of interest expense. But when we added the income tax deductibility of interest expense with a marginal tax rate here of 35% and applied this formula, which is the same one that's on our slide, we got a weighted average cost of capital of about 6.7%, or a reduction in the overall cost of financing that's due to the income tax deductibility of interest expense. So the first and most obvious effect is that income tax deductibility of interest expense creates a lower financing cost and thereby increases the value of the firm. A second effect is that this tax deduction creates an interest tax shield, which is the tax savings resulting from the deductibility of the interest payments. The tax shield is calculated as the interest rate times the marginal tax rate times the amount of money borrowed. The presence of the tax shield increases the value of the firm by the present value of the tax shield. So the idea is that the firm enjoys this tax shield out over time, or kind of indefinitely. So to calculate the present value of the tax shield, we have in the numerator the tax shield itself, and in the denominator we have the interest rate paid, and this present value calculation is an application of the perpetuity formula. Let's look at the calculation of the value of the tax shield for Crow Hardwoods. I put the calculation up in this part of the worksheet. We have an interest rate on debt of 4.8%. We have a marginal tax rate of 35%. Crow has borrowed $50 million. That's what we use down here for our our weighted average cost of capital calculation. So the value of the tax shield is simply the product of the interest rate times the marginal tax rate times the amount borrowed. And that comes to $840,000. And then the present value of the tax shield is calculated as the tax shield divided by the interest rate on the debt, and that's a perpetual value, or a value of a perpetuity, where the perpetuity is the $840,000 tax shield out kind of indefinitely, and that value is $17,500,000. So the idea is that the firm's value increases by $17.5 million because it's chosen to finance itself with 50% debt and 50% equity. Put another way, the value to the firm of the tax law, which allows it to deduct interest expense from its tax liability, is $17.5 million. So the tax shield increases firm value so that the firm value now can be seen as the value of the firm if it were all equity financed plus the present value of the tax shield. The implication is that firms with higher tax rates and other debt subsidies should use more debt than firms with lower tax rates or generally lower subsidies for the use of debt. But we need to balance the benefits of debt against the cost of debt, which derive from the costs of financial distress. Financial distress is defined as bankruptcy, or what the textbook calls skating on thin ice, which means that the firm has insufficient cash to meet its short-term obligations in a comfortable way. And the key short-term obligations are payroll and debt service. The causes of financial distress are, first, business risk, that is, the firm is operating in product and or factor markets where the cash flows are uncertain, and financial risk, where the firm uses a high debt financing ratio and thereby increases the variability that we saw in the Macbeth spot removers case. The costs of financial distress to the firm are many. The first is that a firm in financial distress, or a firm that is suffering from a shortage of cash, is likely to make distorted business decisions. Maybe the firm fails to undertake a new business venture because it feels cash strapped. Or maybe a firm pulls cash out of an existing profitable venture because it needs to make payroll. The second type of financial distress is bond covenants imposed by lenders. We've discussed bond covenants earlier in the course, and recall they are clauses in debt contracts that are there to increase the security that lenders feel, or to increase the likelihood that lenders will get their money back in the case that the firm gets into financial distress, or are there even to prevent a borrowing firm from getting into financial distress through bad business decisions. Here's a list of some of the more common covenants that might be imposed by lenders. Control over additional indebtedness. A requirement to maintain cash reserves. A requirement to maintain the value of assets that are used as explicit or implicit collateral for the loan. And control over other business decisions. These covenants impose costs on the borrowers that are part of the costs of financial distress. The final type of cost of financial distress is the imposition or requirement of higher interest rates to compensate the lender for taking on the higher risk associated with a firm that might get into financial distress or might suffer a severe financial distress. The implications of the existence of financial distress as a particular type of market imperfection are that firms that face higher business risk because of the types of markets in which they operate should generally use less debt financing, and that firms with a lesser ability to monetize their assets or to sell their assets for cash should use less debt financing. This graph shows the trade-off between the benefits of debt and the costs of debt. On the x-axis here is the amount of debt, or maybe the debt financing ratio. On the y-axis is the market value of the firm. Now let's start with a firm that has no debt, and so its market value is the value of the unlevered firm, or essentially the value that's created by the firm's businesses. Adding debt to the financial structure of the firm creates an interest tax shield. And the value of the tax shield, as we have seen, is proportional to the amount of debt on the capital structure of the firm. So as debt is added, the value of the tax shield goes up by this blue line. Actually, the difference between the blue line and this black line is the present value of the tax shield. And you can see that that value increases as we go to the right on the debt axis. But in addition, as we add debt, the firm suffers increasing costs of financial distress. Essentially, the notion is, as the firm continues to add debt, the suppliers of both debt and equity capital penalize the firm by requiring higher rates of return on both debt and equity, and also imposing covenants and other controls that increase the cost of financial distress. And the difference between this blue line and the red line, that wedge here, represents the cost of financial distress. So if we just now trace out this red line, you can think of it as almost the inverse of the weighted average cost of capital curve. So we have an inverted U shape, and at the peak of the red line is where the value of the firm is maximized, and that peak maps out the optimal amount of debt according to this firm's particular situation that balances the benefits of debt in the form of the tax shield against the cost of debt in the form of the cost of financial distress. An important message available here is that this particular point, which maps out the optimal amount of debt for the firm, depends importantly on the firm's particular situation. And just kind of to review, firms that have significant debt subsidies will have a tax shield value that is higher here, and that higher tax shield value will push out the optimal amount of debt for that firm. Firms that face significant costs of financial distress will see this wedge grow more rapidly and to be a larger amount as they add debt. And so the cost of financial distress for these firms will push the optimal amount of debt back to the left for those firms. And once again, to review, firms that face significant costs of financial distress tend to be firms in markets with high business risk, or firms that don't have assets that can be monetized or converted to cash if they do get into financial distress. So the whole point here is that the optimal amount of debt depends on the particular conditions of the firm and the markets within which it operates. This graph reinforces the point that lenders penalize firms for taking on higher debt financing ratios. So it simply shows that the interest rate charged on debt rises as the debt financing ratio goes up. The mechanism for the increase in the interest rate is something we've discussed before. The credit community evaluates the firm as a less worthy credit risk and will, let's say, downgrade the credit rating of the firm and thereby increase the interest rates that the firm has to pay to borrow funds. The last few slides have indicated or demonstrated the trade-off theory of optimal capital structure, which essentially says that capital structure should be based on a trade-off between the benefits or tax savings associated with debt and the costs or financial distress associated with debt. There's another theory of capital structure that's kind of a competing theory that I won't go into in a lot of detail here, and you can read about. Essentially, this theory says that firms have an ordered preference for financing that starts with internal sources or profits. That is, firms first prefer to use profits from operations as financing sources or to finance their assets. Next, they move to debt financing as the preferred external source. And last, they use external equity financing.